Nos vamos a una entrevista. Doy la bienvenida a James Latimer-Butler, Emerging Markets Equity Investment Strategist at AllianceBernstein. Hello, James. Nice to meet you. Thank you for being with us.
Hi, pleasure to meet you too. Thank you for having me.
James, I would like to ask you, given the U.S. valuations are above historic norms, are U.S. equities in a bubble right now?
US valuations are undeniably elevated relative to long-term averages. I wouldn't necessarily characterize today's market as a bubble. Crucially, these valuations are being supported by fundamentals. Earnings revisions, they remain positive, corporate profitability is resilient, and the US continues to lead in innovation, particularly around AI-driven productivity. That helps to justify the valuation premium. The macro backdrop is clearly more complex. Higher equilibrium inflation, softer global growth are real risks. But US corporates have demonstrated a strong ability to adapt. Productivity gains and efficiency improvements are increasingly visible in reported earnings, reinforcing the idea that investors are paying for quality, cash flows, and structural growth and not speculation. That's why I'm cautious about the bubble narrative. I mean, our assessment is we're not seeing the classic bubble behavior. Markets are still discriminating companies. So robust fundamentals are being rewarded, while weaker balance sheets and unproven business models are not. So those high valuations don't mean investors need to stay away, they mean selectivity matters more. So in that context, the US remains one of the deepest and most innovative equity markets globally, with strong exposure to long-term productivity themes such as AI, digital transformation, and that's why approaches that emphasize fundamentals, cash flows, discipline, including how we approach the US equities through strategies like our US Select Equity strategy, are particularly relevant in this environment.
James, as well, how worried should investors be about the concentration in the US market, especially with the dominance of the Magnificent Seven?
That's a great question. US equity performance continues to be driven by a small cohort of mega cap technology and AI exposed names. Their fundamentals are long-term duration growth. Their stories, they remain compelling, but leadership has become increasingly crowded, and with a handful of stocks capturing a disproportionate share of the index returns. So that concentration does raise vulnerability. If sentiment around AI or large cap tech moderates, that will impact benchmark heavy portfolio names, and that'll be meaningful. As index weights skew towards a small group of high beta names, capturing diversified exposures through passive allocations, that becomes more challenging. So I think this is where investors need to step back from the benchmark and think like portfolio builders rather than index allocators. I think the key question isn't whether these companies are high quality, it's how much concentration risk are you willing to carry. Concentration benchmarks force explicit decisions around conviction sizing and risk appetite. But how many positions do you genuinely want at 8, 10, or even a higher percentage of weights in your portfolio? And what else? What are you giving up elsewhere in the portfolio to fund that exposure? So importantly, beneath the headline concentration, the broader US market remains fundamentally healthy. Balance sheets are strong, consumers are resilient, and many high-quality businesses outside that narrow leadership cohort, they continue to offer attractive opportunities. So in that sense, concentration risk is less about avoiding the US market and more about being deliberate about how you build your exposure there.
James, and how should investors think about style, stick with growth, or rebalance?
One of the strengths of the US equity markets is the depth across styles. So growth, value, quality, they're all large, liquid, and investable universes. And that gives investors a genuine flexibility to express style views rather than simply inheriting the benchmark's concentrated leadership. So growth continues to benefit from the powerful structural tailwinds, including AI adoption, faster innovation cycles, supportive policy dynamics. At the same time, value is re-emerging as a useful diversifier for portfolios seeking broader participation. So that's easing inflation and lower rate volatility. They're supporting areas such as industrials, financials, and select cyclicals. So value today can be seen less about defensiveness and more about accessing improving fundamentals where expectations are lower. The important point here is not that one style is right and the other one is wrong necessarily, but the style risk has become more visible. With leadership highly concentrated and dispersion elevated, investors need to be clear about how much of their return profile is tied to one set of these drivers. So in that context, some investors may choose to express high conviction style views, while others may prefer flexible or blended approaches to manage concentration and regime risk. I mean, the common thread is intentionality, understanding the style exposures on your own, why you own it, and how it behaves if the broader leadership changes. So ultimately, in today's environment, it rewards clarity of position and not defaulting to the benchmark.
James, so looking ahead, what's your outlook for the US market over the next 6-12 months?
Our outlook remains constructive. Earnings momentum is holding up well. The AI-driven capital expenditure cycle is still in its early stages, and policy settings remain broadly supportive. Recent forecasts also point to a firmer US growth and continued easing of recession risk as we look through 2026. If economic activity continues to broaden, we would expect market leadership to broaden as well. So that creates space for high-quality businesses, cyclicals, and select value exposures to participate alongside the current AI leaders. So structurally, the US continues to stand out as one of the world's most innovative, profitable, liquid equity markets, reinforcing its role as a long-term core allocation. However, we are closely monitoring the geopolitical risks and the policy risks, including renewed tariff threats, shifting US-Europe trade dynamics, and the potential for more targeted policy pressures. It's an increasingly fragmented global landscape, and these risks can create short-term volatility. But historically, US corporates have shown a strong ability to adapt. So taken together, this argues for a broad and balanced approach to US equities, one that captures today's leadership, but also is positioned for potential broadening of returns as the cycle evolves. So staying invested while remaining disciplined on concentration and style. And that remains a sensible strategy.
James Latimer-Butler, Emerging Markets Equity Investments Strategist at AllianceBernstein. Thank you so much for being with us today. It's been a pleasure to talk with you and to see as well how it's going to react in the markets and your outlook for the next few months. Thank you. Have a good rest of your day, James.
Thank you.